Hi, Startup Vision. I'm Fabrice Grinda, an angel investor and entrepreneur.
Hello, Fabrice. Thank you so much for being here on Startup Vision to share your thoughts and advice with us. Today, Fabrice Grinda is very well known to be a very successful angel investor. You have an impressive portfolio of more than 530 companies. You ran several of them. So, in fact, you're a real entrepreneur. You have that in your blood. How would you define yourself?
I actually would define myself as an entrepreneur. I mean, as a kid, I was actually already building computers, built my first company in high school in France, actually in Nice, which was definitely not the done thing. Built my first first startup to pay for college when I was at Princeton. And even though after graduating, I went to McKinsey, to me, it was like business school, except they pay you. It was always like a finishing school. I knew I wanted to be in tech. And so I've been building tech companies for the last 22 years, and it's definitely my life's work and passion.
So, as a young entrepreneur, you went through some tough times in New York with one of your companies, Zingy. You can definitely speak about resilience. And today you say that the only KPI, the real KPI, is survival. So, what would be your advice to entrepreneurs now to survive this crisis?
The I mean, first of all, what's interesting is even though this is probably going to be, from an economic perspective, the biggest crisis we faced since the Great Depression, for actually a startup founder, this is probably going to be less impactful than the explosion of the bubble in 2000, 2001. I mean, we went from a world in 99, 2000 where I was 24. I had no idea what I was doing, and people were like sending me binding term sheets for tens of millions of dollars from people I never met before. I mean, that's a real bubble, something of the like we haven't seen in the last 20 years. But the explosion was literally the opposite, where even though you had extraordinary ideas and it was frankly the best time to ever build a company, it was impossible to raise a dollar. I mean, I lived in New York, especially on the office, sleeping on the couch on $2 a day, with the only one objective to get a profitability. And in so doing, this payroll 27 times is really, really difficult. So advice for today is you need to make it through to the other side of this whenever that ends. And of course, the big unknown is how long is this crisis going to end? And so what most of the companies in the portfolio have done, and of course, there's exceptions to it because some were benefiting more from the crisis and some were actually hurting a lot more. But on an average, I'd say most of the companies have let go 30% of their staff. They've cut salaries by 30%. And many of the founders who could afford to have cut their salaries to zero. And you use this moment in time to basically create to recreate your culture where you're like, okay, we're all in this together. We're facing this frankly life or death situation. This is an existential crisis for the company, and those who are left are going to be, or the ones who are the most committed, and we're going to see it to the other side. Now, if you're a late stage company, your objective is to get a profitability. So your only KPI now is, are we going to be profitable? Because once you're profitable, you're masters of your destiny. Now, if you're an early stage company, obviously you don't have the revenues that will allow you to be profitable. So it's really, can you survive this? Which really means, from my perspective today, to get 18 to 24 months of cash. And you have to do whatever you can to be in a position to survive the next 18 to 24 months.
So, you went through a period of introspections and you left a lot of material things on the side to be recentered on the human factor. And in fact, what we're going through right now is a sort of forced introspection for half of the world. So what would be the positive outcomes for startups, let's say?
There are a lot of positive things that could come out of this. So first of all, I think we're redefining the way we work. We're accelerating a lot of the trends that were going to happen in terms of like online food ordering, telemedicine, online education. And so if you're in the startup space, typically you're providing a better user experience than the existing offline established incumbents, and usually cheaper. But that transition takes time. Now that everyone's actually connecting and doing things online, that acceleration is coming. And so your value proposition is only becoming more meaningful. So most startups are actually going to come out of this in a better and stronger position to the extent they do make it out of this than they were coming in. Separately, if you're an entrepreneur, this is probably the very best time to start a company. The opportunity cost of your time has gone down dramatically. It's not as though Google or Microsoft are going to start offering you these $1 million jobs that have amazing work-life balance. So the opportunity cost of time is decreased. You're less likely to face competition in whatever business or industry you face because most companies. So you're not going to have 20 people funded doing the exact same thing as you. It's going to be a lot easier to attract extraordinary talents because the unemployment is a lot higher than it was before. And companies are actually letting go amazing people just because they can't afford them and their businesses have been hurt. But it's not because those people are not good, it's just they can't afford them. And last but not least, your customer acquisition costs are going to be lower than they've ever been, not only because you're not facing direct competition, but because no one else is advertising. And so if you think of the way Google or Facebook's advertising system works, it's really an auction mechanism. And if there's no one bidding on the keywords, advertising becomes really, really cheap. And we're seeing at the same time the conversions are increasing because there's not that many people that you're not overwhelmed with ads the way you were before. In fact, this is also the very best time to be doing business development or sales because the people that you need to talk to are not confined at home and not so busy and not traveling all the time. And if you're a startup, historically it was kind of hard to get the time of day from larger enterprise, but today they're so desperate for business that they're actually willing to engage. And so you're in a great position to do deals that you thought might have been unavailable before.
And like you say very often, great companies were created after the 2008, 2009 recession crisis.
Yeah, actually, I'd say more than that. It's not just great companies were created in 2008, 2009. The most defining companies of the last decade were created in 2008, 2009. Uber, Airbnb, Slack, WhatsApp. And it's not a coincidence because they actually benefited from the four elements that I described earlier.
So e-commerce is on the rise more than ever. You're an expert in the marketplace world. So what could these startups do to transform an opportunity into success right now?
Well, first of all, e-commerce may be on the rise, but people's discretionary income is probably falling here. So it's unclear. It doesn't necessarily mean that if you're in e-commerce, you're going to do well, just because people might be careful. That said, we're still at the very, very beginning of the tech revolution. I mean, only 15% of commerce is online right now, and that's going to go to 50% or more. At the same time, there are entire segments of the economy that have barely been touched by the technology revolution. So healthcare, which is 17.6% of GDP in the US, is until this crisis been completely offline. And only now is telemedicine starting. Education, which is about 10% of GDP in most of the OECD countries, was completely done offline. And you only had like the beginnings of it on continuing education with companies like Lambda or Teachable or Udemy. And it's only now that you're seeing actually the entire K through 12 system in the US has now gone to online schooling. And so it's going to create a behavior change that's going to accelerate that opportunity. But we're seeing it everywhere else. I mean, my long-term vision, for instance, of the future of food was that no one will be cooking at home. And the reason is in the future, when you can have food made in dark kitchens where the delivery cost is essentially zero because you have either enough density or because you have self-driving vehicles, then you're going to have higher quality food that's organic, that's completely traceable at great prices, delivered to you in 15 minutes. Then it won't make sense for you to cook. The same way that 100 years ago you would have been doing or sewing or knitting your own clothes, and now that's completely unthinkable. And that is only going to be accelerated by what's going on here as everyone is ordering food online, and we're seeing all of our food delivery startups are growing. All of the grocery delivery startups like Instacart are doing really well. So I would say that if you align yourself with the general mega trends of digitization and remote work and remote learning and remote medicine, there are extraordinary opportunities to be had. Obviously, make sure that you raise enough money that you're going to be around for the next 18 to 24 months so that you can see it to the other side of this, and take advantage of this crisis to sign the business development deals of your dreams that you never thought were possible.
Let's talk about that. You seem to have very clear principles, and one of them is transparency. And you decide in less than a week if you're going to invest in a company or not, sometimes with a phone call. And so, how would you define your decision making process? And will you continue investing at the same pace?
So I've always been decisive. As an entrepreneur, I often realize that it's better to make a decision, even if it's the wrong one, and then measure everything and adjust accordingly. And so we threw a lot of spaghetti at the wall. Many of the decisions I made were incorrect, but then you course correct and you rectify yourself. And so especially in tech, which is a fast moving environment where you don't really know what the correct answer is, it's usually better to actually be decisive than to try to find consensus. And obviously, you want to use an informed decisions. You use whatever data you have available. Now, I've kind of applied the same principles as an investor. I've realized that first of all, I'm only investing in marketplaces, and at this point, I've been doing it for 22 years. So I have a lot of pattern recognition. So I've been using these heuristics in terms of what is it of a good team? What is a good business? What are good reasonable terms? And does it fall in line with my vision of what the future holds to be able to value the startup within 1 hour? And the reason I do that is as an entrepreneur, I found it extremely frustrating when I would go to VCs and I would have an amazing conversation I thought went well, and then I would hear from them for a month or 2 months, or then I'd have another meeting, and it would be an entire 6 month long process to raise capital, even though I'm repeating the same story over and over again. Nothing really has changed because most investors don't like to say no because they want to preserve the optionality of changing their mind in the future, and B, they're also somewhat consensus driven. Now, in a way, FJ Labs is a bit of an enlightened dictatorship, I'd like it to believe. And so if I want to invest, we'll invest. And the same applies for my partner. If he wants to invest, we'll invest. And that allows us to be decisive. Now, we are continuing to invest in this time of crisis, with the caveat that be, it makes more sense right now to invest in the early stages than the late stages. And the reason it makes more sense to invest in the early stages is the macroeconomic environment that matters to you if you're an early stage startup is not the one today. It's the one 7 years in the future, 10 years in the future when you're seeking an exit, and who knows where that will be. That said, what does matter when we're investing today is you make sure that you have enough capital for the next 18 to 24 months, and that you're in an industry that's not disproportionately impacted by COVID. And so any of the categories we described before, from e-commerce to food delivery to actually marketplaces for nurses to online education or healthcare, make a lot of sense. But if you're in, I don't know, offline events or tourism, it's unclear how quickly those will recover. And so those we'd be way more cautious of. Also, we don't lead deals. We're typically co-investors alongside other VCs. So we still want to make sure that you have a lead and enough capital to last 18 to 24 months. But if anything, we've been as active as ever before. I think we've made 10 investments in the last month and a half, partly because we've applied this philosophy, and also partly because we use this opportunity to go to the top companies in the world and that we were not investors in. And we said, hey, would you like extra capital at last year's valuation, to give you a bit more cushion? And most people were up for it. And so it's been an opportunity to invest in extraordinary companies with extraordinary entrepreneurs that we were not investors in before.
And do you think other VCs will follow the same policies as you do, or do they have less freedom?
So most VCs have slowed down their investing dramatically, and the entire world at large is more in a risk-off mode for multiple reasons. I mean, often they are the lead investor in many startups, and so they want to make sure that these startups survive. So they're more in a portfolio preservation mode. We will allocate our capital to the companies we're investors in rather than let's deploy new capital and new opportunities. So that's one. Two is it depends where you are in your venture fund life cycle. Many VCs don't have that much capital left because they were late and they were thinking of raising the new funds. But right now, it's probably the worst time in the world to be raising a new fund as a venture capitalist. And so, to the extent they don't have that much capital, they can't be aggressive. So, in general, venture has decreased dramatically, especially at the late stages, but also at the early stages. It's just we're not the lead, so we're not the ones who are going to be saving your company if you need extra cash right now. We can write a little check, but that's not going to move the needle that much. And so we're still in a position to be writing these huge checks just because structurally we're a very different type of animal than a normal venture fund.
To wrap up this interview, I would like to bring your economist view, of the situation. How do you see the next 12 to 24 months? Tough
So,
question.
yeah, no. So look, what's interesting is if you'd asked me in early 2020 or in January or late last year, what was my fear uh, for this year, is that we were heading to a new debt crisis, and the reason is we have record levels of corporate debt, record levels of consumer debt, record levels of sovereign debt, greater than we had in the 2008-2009 recession. And what's interesting is actually this crisis will only increase the overall debt level, but I'm no longer worried about a debt crisis because the states are going to lower rates and even though you're going to borrow more, you're going to be in a position to repay those loans better than ever before. And so the policymakers have learned the lessons of the past, right? The Great Depression was frankly made worse by the Fed and not backstopping the balance sheets of the banks. And so there were runs on banks and the monetary liquidity disappeared and increasing rates too early. The 2008-2009 crisis, it took them a long time to realize that they had to provide enough liquidity to have the entire financial machinery continue working. Right now, they're very proactive. I mean, both fiscally, where all the countries in the world are spending a lot of money to help the needy, which they should. That is the role of the state, to help the people in times of need, and the central banks or printing money and buying bonds and keeping interest rates low, which again makes sense. So I no longer worry that we're facing a massive financial crisis. Now, when will we recover from this? Of course, the duration of this is unknown. It is a big unknown, especially since the ultimate virality, mortality is not clear. When we will get a cure is not clear. When we will get a vaccine is not clear. But also when the policymakers are going to decide in terms of when they want to reopen and what risk trade-off they're willing to take in terms of increased potential death and overwhelming of the healthcare system versus economic costs is also unclear. But those are policy decisions rather than economic decisions per se. And so it's really hard. It's harder to gauge, but clearly it seems like we're heading for some type of reopening in the next few months in June, July, August. And then we'll see whether or not we have a second wave and whether or not we have a new level of restrictions and how quickly it recovers. I suspect I'd be very cautious for 2020 in general, at every level, as an individual, as a founder, as an entrepreneur, in terms of how much economic growth we're going to see and revenues we're going to have, and I guess more cautiously optimistic in 2021, mostly because I'm seeing that the policymakers are very thoughtful and aggressive in terms of making sure that we don't face a massive liquidity crunch and making sure that the people that are laid off are actually having or facing a safety net. In something that could come out of this that could be positive is actually a fundamental rediscussion of how our healthcare system works in the US, for instance. It doesn't make sense that we have employer-provided healthcare where if you lose your job, you're going to lose your healthcare. And frankly, it's a legacy of World War II where we had wage controls. And so in order to compete for talent, the employers lobbied Congress to make healthcare tax deductible, which made it cheaper to be provided by employers. But that's a legacy of a tax change. There's no reason it should be that way. You should be the consumer of your own health. Same thing on what level of safety net we find is acceptable. And so they may very well lead to a fundamental conversation about the nature of the state and its role in the economy, and that'll be a good outcome of this. But it won't happen in the next 12 months or 20 to 24 months, but it definitely will probably come in the next few years as we get the lessons out of this.
Thank you so much, Fabrice. It was great, and I hope you will come back to discuss more on what's happening on Startup Vision TV. Thank you so much.
I'd be delighted to. Thank you for having me.